Well, folks, for the past year, the bears have come out of full hibernation and they have been having a whole lot of fun. And surprisingly, the bulls went into hibernation for the past year. You don't see that too often. But now, emerging from the cold snow, the bulls are starting to come back to life and try to figure out what's going on in this world. And oh my gosh, you get a few positive days in the market, and look at this. We got a few people that are coming out of hibernation. Look at this one. The textbook bottom presents an opportunity for long-term investors. All right, we'll react to that video here today. This one, bear market rally has further upside, says Wells Fargo's Chris Harvey. Okay, we'll react to that one too. And then a halftime report, investment committee on their best tech stocks to buy. So we'll listen to that and I'll react to that and kind of give my 2 cents. Hope you guys enjoy this video. As always, thank you for everybody that's here. We are over 16,500 plus subscribers. You got to be flipping my flapjacks? Come on, man. That's just ridiculous. So I appreciate each and every one of you being subscribed to the channel. Thank you, thank you. I'm glad you're enjoying the reaction channel. I enjoy doing these videos. They're always a lot of fun. I love giving my opinion versus other people's opinions, and having a debate with myself. It's always a fun time. So hope you guys enjoy this, okay? If you're looking to get my free stock picking checklist, check out pinned comment down there. I'll have that for you, and we'll send that over to your email, or if you want it via text or whatever, we'll send that over to you, and you can check that out, okay? Also, if you're looking to join my private stock group and the private Discord chat, everything like that, that'll be linked in the description. Alrighty, let's get into it.
Back to you. Thanks for coming on. How do we know this all just giant short covering head fake in a downtrend?
Always possible. You got to look at the weight of the evidence. Again, the key reversal day, that's when you have big opening losses that get reversed into the close. That is an indication of downside exhaustion. And it's not just that reversal alone, but what's adding to its efficacy are four things. One, where it occurred. It occurred at a very important level, 3,500 on the S&P 500. That's the 50% retracement of the prior bull market, which is where the majority of bear cycles through history have been limited to. Point two, it occurred with very deeply oversold market cycle indicators, breadth and sentiment levels on par with what we saw in even March of 2009, levels that have been followed by above average returns. Point three occurred with indications of downside selling intensity that was abating versus where we were in June. Typically, that type of divergence occurs at a reversal point. And all this, the final point, occurring with the emergence of bullish seasonal. So this is textbook criteria, Brian. This is why we see an opportunity for the long-term investor. The missing piece, of course, is interest rates, which has really driven this sell-off. I'd like to see that 10-year yield lower. So there is that lingering concern from a near-term basis. But for the long-term investor, we see this as opportunity.
Where's the confirmation signs? What do we need to see?
So this is interesting because this is obviously coming from a technical angle and a technical trader, right? And so a lot of these folks, which they make up a huge segment of the market, do not underestimate how big of a segment. It'd be interesting if it was just people like myself that are long-term investors and are like, I'm buying this stock for the next 5 years. Much of the market is not people like me. It is these technical folks looking at this data, right, and saying, things are really bad. I got to sell more, or I got to buy now because this certain technical, or we just hit the 150-day moving average on this stock, or the 200-day moving average, and all these sorts of things, right? And so, this is interesting that you're starting to get one of these technical traders over. And you got to understand, as things improve in the market, what that also does is it creates a situation where a lot of these technical traders start piling on more and more as you get the upside. And that's just one of many reasons why you get these explosive upside moves that end up lasting sometimes months and maybe get to overbought conditions. I think it's a big part because these technical traders are looking at all this stuff, and if it hits this, they hit that, and then I gotta buy, right? And then you get the fundamental folks that come on top of that, and it's just a whole host of just buyers.
Well, let's start with the 10-year yield, watching 3.5%. That was the June peak. So if you fall below the June peak, that's an indication of a failed breakout and exhaustion there in the rate market as well. And on the upside for the S&P, we can consider this counter trend while you're below the 200-day, but you start to move above that 200-day average, and a lot of long-term trend signals are going to flip positive, and all of a sudden you have the emergence of a new bull market.
You heard that? Trend signals? You heard that? New bull market. Those are important terms, okay? You know, if you start hearing that from more and more folks, oh boy, okay? Now, what's interesting, if the 10-year starts going down and the dollar starts going down, do not be surprised if that exacerbates the move in the market over the next couple months. You know, that's why that's why on the main channel I've been covering, that, for the last few days that we're set up for an absolute epic rally, because you're getting basically a convergence of so many various things all simultaneously happening that had all been working against the market all at the same exact time, that are starting to slowly, and I mean slowly, start to work for the market and are likely going to be working for the market over the next, let's just call it 1 to 2 months. That's going to create a very interesting, last couple months this year. I can tell you that.
What would be a sign of failure? And I mean, aside from stocks going back down, of course.
Right. So, listen, there's always the tail risk scenario. And for perhaps you want to, if you're worried about, you can't be in and out, you want to wait for the lagging confirmation, the base and turn. But even just from a trading basis, keep an eye on the June low. It's around 36.37. We're back above there today. We fell below it Friday. As long as we're above it, you have the setup for a failed breakdown below the June low. But what you're going to be looking for, Brian, really is it's not just the level on the downside, but if we start to see selling intensity pick back up and a surge in new lows again, that would have to restart the whole bottoming process.
All right, it's Monday. Let's be in a good mood. Leave us with some opportunity here. Chipotle, CMG. What's on the chart that makes this look attractive to you?
Chipotle.
Yeah, well, so the case for us is that the breadth of stocks at the least have lightly bottomed here, if not the stock market. We are seeing improvements in breadth. A lot of consumer names like Chipotle, names that broke out during that summer rally, that reversed their decline. And while the market was sliding in the third quarter, it developed more as a consolidation within a reversal for a name like Chipotle, which is back to the 200-day average. It's a name also covered at the firm with an outperform rating. Our analyst, Brian Bittner, likes it as a top idea. We call it an opco trifecta. It sets up well. We think that reversal's intact. And this is a great name to play what we think is a market recovery.
Interesting. Yeah, Chipotle has not been hit very hard. Only down, this year, this is the biggest win maybe in the stock market. Chipotle's only down. Chipotle, 9%? A little under 9% for the whole year? Come on, man. This is going to be the best stock in the world. Geez, I wish all my stocks were only down 9% this year. Oh my gosh, okay. Interesting thing is that Chipotle always trades rich. That's why I've never been able to buy this stock. I don't mind paying rich sometimes for companies, but, I don't know, like fast food. Well, I don't want to call it fast food. It's fast casual. So, yeah, interesting. The technical part there is very important because there's so many of these folks that look at the technicals, and everything literally has been working against us in the market from the technical side until pretty much the past trading day or two. So that's interesting. Okay, next one up here. Bear market rally has further upside, says Chris Harvey from Wells Fargo.
Through all this, probably champing at the bit. It is, I believe it is champing, not chomping. People say chomping, but it's champing. Chris Harvey, Wells Fargo. Chris, thank you. You heard our discussion. I'm not going to ask you to slam the Fed or agree with the Fed, but no matter how good earnings may come in over the next couple of weeks, how good the guidance is, will the Fed still matter more, or have we gotten to the point where now everybody knows what the Fed's going to do? Earnings will make or break this market.
Earnings matter for the next 3 weeks. After that, 3 or 4 weeks, I would say that. 3 or 4 weeks, earnings matter. After that, the earnings opinion can start slowly fading, and then it will the momentum will move back to the Fed, CPI, inflation numbers, things like that, and even looking forward to 2023 at that point in time. But for the next 3 to 4 weeks, those markets are 100% driven by what's going on with earnings and just the overall insane positive momentum that's about to come in the market.
I don't think earnings make or break the market. What earnings do is they start a rally. And it's just a trading rally. As you pointed out before, it's a rent not own type situation. What the Fed does is the market doesn't stop going down, or we don't make a bottom until something breaks in the capital markets and the Fed pivots. Or earnings come down not 2, 3, 4, 5%, but 10%. So we're still just sitting in front of things that are yet to unfold. And what we're looking at is just the cost of capital has gone higher. Fundamentals are still okay. They'll get worse, and that's the problem.
What do you mean we're looking until something breaks?
Well, if you look over, you talked about the UK. If you look over the UK, it looked like the pound was going to break. It looked like the euro is also down, right? It could be a collapse of a currency. It could be a collapse of sentiment. It could be something in the Ukraine.
What about disinflation going down?
Inflation, I think inflation is going down, and I think if you were ever going to use a transitory word, you would use it right here, right now. A year ago, we were saying, I've never seen prices as high as this. People were coming in and demand twice as high. People were raising prices 5, 10, 15%, and people were saying, I'll take 2, I'll take 3. Now they're saying, whoa, wait a minute. I'm not going to pay that for that, right? And so now's the time where inflation does come down. What I think we need to worry about more is, why are we stuck on this 2% inflation rate? Is 3 or 4, as long as it's stable, is that the right rate? And maybe that is, but I'm not sure we're going to have that conversation just yet.
But if you think about inflation and goods inflation and then the services side of the inflation, if we say all the time that we need to see unemployment and whatever that level is, that the Fed isn't going to say it outright, but it's probably north of 5%. That's really the inflation to worry about, isn't it? Because this is a consumer that at this point is making more money and in some sense is able to ride out this storm.
Right. I think it's a difference between the inflation the Fed sees and the inflation that you and I see. Right? The Fed sees something, hey, CPI isn't cracking. CPI is plateauing around 6%. We need to get it down. We need our credibility back. We have to get it down. But when you and I look at things, what you see is a situation where the underlying fundamentals are starting to roll over, that the things that are going to pull down inflation are rolling over, whether it's interest rates, whether it's demand, whether it's the supply chain. So at the end of the day, inflation is going to come down. How quickly is a big question, and the way the Fed reacts to it is more important.
I agree.
So, Chris, when you think about what Brian was just saying before, like people got lured in, they were buying things, whether it was crypto or NFTs or SPACs. I mean, the list goes on, or unprofitable tech companies that have recently gone public. A lot of the air has come out of that. I think we can all agree that that trade is kind of done. And when we're talking about the broader markets, you look at the S&P 500 and you say down 22%. That's not so bad. Right. Do you think of the market as a monolith, as equities across different spectrums? Is there a way that if the average decline of the S&P 500 in the post-world war era was about 35% during a recession, let's say we are in a recession at some point, do we have to go down 35%?
The answer is no, we don't have to go down 10, 15, 5%. Well, but until the Fed pivots, what's happening now? The cost of capital is going higher. So there's a duration trade. That's pushing prices down. That's pushing stock prices down. More importantly, we haven't gotten to the fundamentals rolling over. Now the fundamentals have to roll over. I think we are going into a recession. I think numbers do have to come down. Until that occurs, we're not going to wash things out. Can you make money? Yes, you can make money renting things, not owning things. Can you make money?
What are we renting then?
So one of the things.
In all due respect to this gentleman, I mean, it sounds like he's all over the place. I'm like, is it just me, or does this gentleman sound like he's all over the place? And even looking at his 2022 range there, did you guys see this? You see this? 3,300, 3,900. It's a pretty big difference there, sir. A massive difference, like between 3,300 and 3,900, right? 3,900, that's, borderline bullish. Okay, I'll take 3,900 at year end. 3,300, that's very, very bearish, right? That would be a situation where the market goes down considerably from here. So even then, I'm kind of like, I don't know. This just seems like he's a little all over the place, I'll be honest.
You can make money renting things, not owning things. Can you make money?
What do we rent?
If I didn't read any headline, I had my eyes closed and just listening to him, I would have trouble telling is he bullish or is he bearish? Because all of a sudden I'll make this bullish point, but then this bearish point, it just seems confusing.
So one of the things we've been talking about to our clients is momentum. Now, it's nothing exciting. It's nothing really sophisticated, but it's things that are working. Stocks that are working, sectors that are working will continue to work. What you want to do is you also want to avoid things that are broken. You don't want to go bottom fishing. You don't want to be contrarian. You're not getting paid for it. And you just have to have this very simple approach. Chart looks good, chart looks bad. Dude. I know it sounds really simple.
Oil and gas looks good.
Oil and gas does look good. And that's, if you look at the momentum index, oil and gas is a big part of the momentum index.
There you go. Chris Harvey of Wells Fargo. Thank you. Kind of shooting for the hip here. Appreciate it. Guy, let's talk about this. I mean, Dan referenced the average drop in the S&P during the recession, I think, is about 35%. I saw some data today that the average time the S&P goes down is 318 days. That's an average. Doesn't mean it's going to be shorter. That's the average, rather. We're day maybe 290 of the decline on the S&P 500. Does it feel like, I'm not saying call a bottom, but does it feel like we're kind of getting closer to the end than the beginning?
Well, I know there's an answer for that question. That was deep, by the way. And just let me address Dan quickly before I answer that. The fallout can be measured in the market. Yeah, it's not a big deal, 25%, 30%. What you can measure in terms of the fallout of this reckless Fed is what's done to the lower and middle class who got screwed on the way in and are now getting royally screwed on the way out with inflation. They don't win here. The wealthy people win on both sides, number one. Number two, yeah, I'm not going to be one of these to call bottom. I think, too, it's a tradable level. And what we're seeing now is eerily reminiscent of what we saw in June. And I think this is one of those bear market bounces. But the math suggests, and the math being $200 worth of earnings, maybe 210 with a 15 or so multiple, that, we're probably staring anywhere between 3,200 and 3,400 in the eyes in terms of the S&P 500.
All right, interesting. So, there was just a lot of what I always talk to you guys about, and what frustrates me about Wall Street and kind of the sheep mentality of like following each other around. And it's like, where's the trades that have been doing good this year? Oh, oil and gas stocks pile in. And, they've been saying that for months now, and those stocks have not performed. Oil and gas has not performed. And they'll be saying it until it doesn't work. And as soon as it breaks, and they'll be like, don't touch the oil and gas stocks anymore. And it's just, that's Wall Street, man. It's very sheep mentality. It is, they herd each other around and just follow each other and stay away from anything that's beaten down. You're not getting paid for that. And it's like, who's not getting paid for that? The fund manager or, an investor who's risking their capital in one of those risk assets, right? And what happens when the prices double at this time next year, triple, like it will be for some of those stocks? Did they get paid for that? I don't know. Just something to think about, right? And quadruple in 3 years from now. I don't know. That's interesting. All right, let's hear these top tech stocks here.
It's Dan Ives, who covers a lot of these companies. And, maybe he's right. We get through this earnings season rather unscathed. But then who knows? Who knows what the story is?
They're all like, I don't want any piece of this, man. Let me just talk bearish on the market because I've been talking bearish every day. Come on, please. It's interesting that Wall Street's already giving up on the hope of this being a bad earnings season. You hear how quick this happened? All we've gotten is bank earnings so far. They've already given up. They threw in the cards that quick. It was like bank earnings, it's not the end of the world, so we give up on this earnings season, right? Isn't that crazy how fast that happens, right? Going into this, a lot of them thought, oh boy, this is going to be, this is going to be the horrible earnings season. Everybody's going to stop spending money. The economy stopped or something like that, right? And now they're all just giving up that because the banks reported that things are decent, and therefore they're like, oh crap, okay, well maybe next earnings season, right? And so they just kind of push the can down the road in regards to that whole situation. Netflix earnings, don't be surprised if that goes boom, 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 boom.
You had the last 10 years, obviously the proverbial FANG, and you could just buy the Qs and have wonderful capital appreciation across the board. I think we're entering this time period. We already see it. We're not entering it, where there's going to be a lot of dispersion among these big tech names. I mean, to me, what's interesting is that, Tesla's down 37% year to date, but it's lost almost all of that in the last month. So a big cap tech name that finds its way in pretty much all of the growth indices has lost, I think it's 27% in the last 30 days. And so Tesla actually comes out with earnings. It's either tomorrow or Wednesday. And so I'm really curious to see that because fundamentally it seems like something's broken down within the stock, not the company within the stock. I mean, look at Facebook, look at Netflix. These are companies that have had huge dispersion from the Googles, the Microsofts, and Apples. And so then I think that investors need to have more awareness of these individual companies because I don't think these FANG-type names or acronym names in general will do well over the next few years. And I think you have to pick your spots. And to Steve's point earlier about semis, semis obviously are very cheap, but everyone needs to think through all of the impact that the White House has done over in China and what that impact is on the individual names because it doesn't treat all of those semiconductor names equally.
Hey, Brent, it's Joe.
Okay, wrong. okay, so where do we start with that whole statement? Okay, she's basically saying stocks like Meta and Netflix aren't going to perform well for the coming years. She mentioned the term years, not months. That's where she made a huge mistake. She could have got away with maybe saying the next few months, even though they're going to perform very well, likely over the next few months as well. But huge mistake, okay? I am certainly not the biggest Netflix bull by any stretch of the imagination. I'll take Fubo stock over Netflix any day of the week, right? Which, by the way, just came out with a very positive pre-announcement. But when it comes to Netflix, they're going to get back to user growth. I hope she understands that. They got the ad platform now, and don't be surprised if they not only make bank from just having that, users in relation to having the ad platform, but in terms of how much money they're going to make per ad served up. Oh my gosh. Okay. So, I just think that's a huge mistake. Meta is the most undervalued stock in the entire stock market right now. That's a mega cap stock, meaning $100 billion plus market cap. And it's not just the most undervalued, it's the most undervalued by a mile. And it's the most disrespected by a mile in the market. At some point in time, valuation does matter again. And just as on the upside, eventually valuation starts to matter, right? And you can't trade at, whatever Zoom was trading at for Forward P and Shopify and those stocks. You can't trade at that forever, right? And eventually people care about valuation again. And when it comes to Meta, that's far too cheap on a valuation basis, and it will matter again, and that stock will go up massively. That stock could 2x in value tomorrow, and it would be undervalued. 2x tomorrow, and it would be undervalued, okay? Valuation does matter at some point in time. And so that matters, and then eventually over the coming years, because she mentioned the term years, the metaverse will start to be understood, and how big that opportunity is will be understood. Right now, less than 1% of the population is even on the wavelength of understanding how big of an opportunity that is. I think it's going to be a much bigger number 3 years from now. Let's just put it that way. Than understands that today. So, I 100% disagree with her. And there's going to be other stocks that I think do have some trouble. Google stock. Although I'm a shareholder of Google now, and I bought that stock recently, I don't think that's going to be necessarily the best performing stock. Google's going to have a lot of trouble with government. I see that being a potential problem there, right? Apple obviously has a richer valuation than it's had in a long, long time, right? So it has that to deal with, So, I just think, when it comes to like Microsoft, right, it hasn't been hurt that much. So is Microsoft going to be a great stock in the coming years? I think it's going to be an okay stock over the coming years, not necessarily a great stock over the coming years. So very, very different opinion than she has.
Isn't it, though, Tesla declining on the expectation that Elon Musk might have to sell stock for the Twitter acquisition?
Sure. Sure. If that goes through at that number, that's part of it. But to have such a big decline on a very expensive name, by the way. Okay, so Tesla's not cheap, and it finds its way through there. Bottom line, if you were an owner of Tesla or have a big, large position, Tesla from a technical chart looking back at 2017 has really broken down against a lot of support. And so now you go into the statisticians and the traders that look at Tesla technically, it doesn't look good. And so all of a sudden that stock can take on a new dynamic because of what Elon had to do. Mm-hmm. But from a trader and a technician, it is what it is. And so that is not positive for large cap tech when Tesla has broken down on these technicals.
Don't ever judge Tesla stock on technicals. I've been in the stock for so many years, and I've just seen so many people try to judge it on these technical indicators and things like that, and it's just the biggest mistake in the world. And the reason is, when it comes to Tesla stock, that baby can change everything in a snap of fingers for positive or negative, and I've seen it both ways, okay? And, everybody can be like, oh, it's trading, it's overbought based upon condition, and it just switches out of overbought in like a snap of fingers, and it's oversold, and then it switches out of that in a snap of fingers, right? And, well, it's here versus its 90-day and its 150-day moving average, and then, boom, Tesla's a different animal, okay? If you're trying to even judge anything on Tesla's in relation to technicals, I think it's hard in relation to all stocks, but it's Tesla, give me a break. It's not that type of stock.
This story is going to be that 2022 earnings are not the problem. But don't write too much into it, because when you really get into the early part of next year, the rubber's going to hit the road of rate hikes and further slowdown. Remember, they've only been hiking rates for 6 months. It takes a good amount of time for all of it to filter in. And
so that's now the narrative, right? And I'm not saying that's a wrong narrative. It's just that's interesting that that's a narrative, because before, there was a lot of folks talking like this earnings season is going to be bad. And now, like I said, they've already are given up on that. Now, like, crap, okay, this one. So let's talk about next earnings season. Let's talk about the 2Q of 23. It's kind of like eventually it's going to get bad, right?
Into the system. My point being, look at, the banks are off to a good start. Look at Bank of America. One of the few stocks that you actually still hold and like.
Yeah, I mean, it was a stellar performance. I mean,
Mr.
Brian Moynihan,
Shorthills.
I've come out and said many times, I think is the top CEO there. I mean, Jamie Dimon, of course, is up there as well. But take a look at what he's done. I was surprised by net interest income, that was and, loan growth. I mean, those were surprising because we haven't had loan growth up until this point. We've had some of it, but not what anybody expected. So there are some stocks to buy. Keep in mind, B of A is well off its highs, and it's a cheap stock. But, if you look at it this way, Jeremy Siegel has been on our show a number of times, been on a lot of CNBC shows. If you buy into what Jeremy Siegel says, then we haven't seen the crash in earnings or the economy. If the point that he's making and that Barry Sternlicht's making, which is that the Fed's gone too far too fast, you're going to see the impact. And that impact is not going to be good for equity markets. And you're right. It takes two quarters to 3 quarters for it to really filter through. And you've still had some pretty good savings out there. And you still have people that prefer their leisure time to working. So they're out there buying more goods and services. But we've yet to see the impact. Now, to Mike Wilson's point, the market continued to go up in the interim. But then you get to saying, okay, how am I going to play this? And I choose to have a point of view and stick with that view. Once again, I'd love to buy some stocks. I love when markets go up. I hate when they go down. But I'm just not there yet.
Oh, stop it. Your fund is named Short Hills Capital. Just stop it, please, okay? Something interesting is going on, right? So the folks that are bearish on the market, very, very bearish, right? They've already sold. Okay? So now the market, who's left to sell at this point in time, right? Now we're getting an earnings season that is already off to a pretty decent start, right? Might even get a little better as we go along. So is there going to be any mass selling there, right? Because the people that are bearish already sold. And there's nothing to make the next group of like big sellers bearish now, right? Especially when you get positive momentum, as we're likely going to get over the next, let's call it 1 to 2 months. So that creates an interesting dynamic. 2023 is a wild card, and a lot's going to shake out into what do all these companies come in with numbers? Where's guidance at? And then obviously once we get into the first quarter earnings of 2023, they're already kicking. You hear it from these Wall Streeters, they're already trying to kick the can down the road a little bit and talking about, well, maybe in 2023, maybe the Fed rate hikes haven't hit the economy, and I'm not going to argue against that, right? But it's interesting to see that can kind of kick down the road already this early in this earnings season. Like we're literally in the first inning of this earnings season, and they already like kicked it down the road here, which is intriguing. I would call it that. So hope you guys enjoyed this video. As always, I appreciate each and every one of you being subscribed to the channel and enjoying these reaction videos with me. Much love as always. Also, if you want that stock picking checklist, check out the pinned comment down there, and we'll send that over to you. Much love as always, and have a great day.